All right, good afternoon, everybody. Today what I'm going to do is basically talk about the market a little bit, talk about how I look at things, and then I'll get into 2 or 3 strategies that I think look interesting in the current environment and why. So just give you a few ideas. Again, like anything else, this stuff is a craft. It takes practice. You know, as much as we all would love to do, show me the money, just give me the, and this is a craft. And you have to learn it. There's no easy way. We teach our students, we put on repeatable trades over and over and over, and you learn to trade them, and whether the market's high or low, or the volatility's high or low, and you learn, right? You learn the craft. So I'm going to focus on the price chart of SPX from this area, which is basically taking us from, this is the correction. See all these red candles down here? That's the correction. And that took about 3 weeks. It started right here on December 29th was the last up day. And we basically went down, ding, 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 down the elevator for 3 weeks till around January 20th, and the fast moved down about 12%. And let me see, Thomas said collapse the left panel for bigger chart. Like collapse it or just move it. All right. So anyway, so that's your correction. And then we went through a period from January 20th till what, maybe a couple weeks ago. We were basically in a range, right? We were in a range of around 1950, right? In this window, 1950 to 1810, maybe 140-point range for about 6.5 weeks. So we had the correction, and we had this range, and then we kind of busted through the 1950, 1955, 1960, whatever the number is, and ran all the way up near the 2050 area, and now we're kind of backing down. And so this move down, was down, the correction was down about 240 points. And this move up in the last literally 5 weeks, right? We've gone from 1840 up near 2050. We almost took care of the whole correction. We came up about 210 points, right? So we've had this correction, and we had a range of about 1950, 1810 for 6 weeks. Then we kind of busted out of there, and we literally, in the last 5 weeks, which is, to me, more significant than the correction, because the fact that I know we can go down fast, right? We went down 240 points in 3 weeks, but still, to me, moving up from 1810 level in the last 5 weeks to 2050, 240 points. Was that right? 1810, 1910, 2010. Yeah, 240 points, basically the same amount down. That's pretty amazing to me. And we backed off a little bit here, right? We're at 20, right now, currently we're at about 20, 30 in the SPX. Now, let me just give you my 2 cents. What do I think? I don't know any more than the guy at the hot dog stand down the block where we're going next. And don't be mad at me for saying this, neither do you. But, I think that's the biggest problem for retail traders. They spend way too much energy trying to control something they can't, instead of dealing with, what's that, the premise of Alcoholics Anonymous, deal with the things you can deal with, right? And to me, I spend time on looking at my trades, looking at my risk management, and also looking, when I'm structuring trades right now, we're at 2030 in the SPX, and VIX is 15, right? This webinar today is, what do we do with VIX at 14, right? And VIX just today went up to 15. But let's say VIX 14 to 15, what are you doing? Let me ask you a question. So instead of, I'm not asking you guys, are you bullish or bearish? I don't care, right? You know, I can go ask the guys at the gas station, are you bullish or bearish? It doesn't matter. What's important to me is if I'm setting up a trade at this point, right? If I'm setting up an iron condor or a credit spread or a butterfly or a calendar or some type of spread, one of the things I'm looking at is after moving up in SPX 240 points in 5 weeks, if I'm structuring a trade, would I want more room on the downside or the upside? Would I want more room or protection on the downside or upside? Well, let me be clear. I'm not talking about a bearish trade or a bullish trade, basically. I'm talking about the typical trade that we put on here, a neutral trade. And I think the term neutral is confusing at times to people, but I want more room on the downside, right? Doesn't mean that we can't go up, but to me, with the VIX at 14, what do I think the risk on the downside is over the next month or two? 12, right? Maybe 11, 3 points. But where's the risk on the upside in the VIX? 20, 30, whatever. I think the same thing on the upside, can we go to 2120 or 2130, 2130, which is the all-time highs or so? Could we? Yeah, sure we could. It's 100 points, but how many of you think this is the start of a new bull market that the world's never seen, right? How many of you think this is the start of a bull market that nobody's seen? I sure don't. And so even if we go up, I think I'm going to be able to deal with the upside. What do I mean deal with the upside? It's not going to go up that fast. Or if it is, in other words, after the market's gone up 240 points, I'm more willing to deal with, I want to put trades on that have more risk on the downside. I read an interesting article, and this is how it is with retail people, right? Because I've seen this, right? If the market has been going up for 240 points, and I asked Thomas and Jim Hardy and Mary and Fred, today we've been going up 240 points, where are we going for the next 50 points? What would they say? What do you think? What do you say? Be honest. If we've been going up 240 points, we're in an uptrend, I said, where's the next 240, where's the next 50 points? What are they going to say? They're going to probably say up. No, they're going to say up, right? I guess what I'm saying is psychologically, right? When the market was at 1810 after the correction here, right? When we were at the bottom after being down 12%, how many of you were ready to sell your house and move to Switzerland? That's being a joke, jokester. But the point is, when we were there, how many of you loaded up to the upside? How many of you were bullish at that point? How many of you were bullish? What's my point? My point is we have a tendency to be bullish after we get bullish after we've been up 200 points in the SPX, and we get bearish after we've gone down 200. I'm not saying in any stretch of the imagination when SPX was down to that point, it's sell the house, sell the wife and the kids and get long. But to me, and again, I don't know many traders at the CBOE over the years that at that point, that's suddenly the right time to get bearish. So maybe a little bit of sentiment. All right. Anyways, I'll get into a couple strategies I'm looking at, I think are decent, and I'll give you for this environment, and we'll go from there. So here's the first trade. Here's a trade that, how many would like a short Vega trade with no volatility risk? Sounds like an oxymoron. How can I do a short Vega trade and have no volatility risk? Well, this is one. Let me show you. So here's the trade. Most people would agree with SPX at 2028. Coming a little less, but most people would say we're in the upper end of the range. Agree? If you look at the range over the last, for the year, we're kind of near the upper end of the range. Would that be fair to say? So when we're in the upper end of the range, and I would say more, we're 2028, but I'm thinking more like 2050 and higher, here's a trade that I like to do. So when we're kind of in the upper end of the range here, I'll call this a ratio fly. And what it is, let me show you what I'm doing here. This particular example, I'm in the April SPX. We're at 2028, the April SPX. And this is what I'm going to do, and then I'll explain it. I've talked about this trade a lot. Just in this current market, I like this. I'm not saying I put it on today. I'd rather put it on with us around 2050, but this is the trade. And this could be used as a hedge against your 401k, right? Which way do you want the market to go for your 401k? Up, right? So this can protect some for the downside. So this is a combination of 3 credit spreads and 1 debit spread. I'm buying 1 2075 call in April. April's around 21 days till expiration. You could do this in May, which has 60 days till expiration. I'm buying 1 2075 call, selling 4 2085 calls, and buying 3 2095 calls. So I have 3 credit spreads and 1 vertical or debit spread. Now, my short option, the 2085 call, I try to get a delta of around 15. So how do I pick my strikes? Well, if we're on a 15 delta, it's close enough, 15, 16 delta, 2085 call, and then I just buy my longs, 1 strike up, and my other long, 1 strike down. So I'm buying 1 2075 call, selling 4 2085 calls. So my short option is about 57 points out of the money. And I'm buying 3 2095 calls. This is my graph at expiration. So it's a short Vega trade, right? If you look, I'm leaning a little bit short deltas on the trade. I'm leaning about 7 deltas on a 1x4x3. I'm leaning 7 deltas short, positive theta. My Vega short 52. And I like to be, especially when I'm in the upper end of the range of a vehicle, I like to be a little short deltas against the short Vega, because if the market goes down and I'm short deltas, right, that's good. If the market goes down and I'm short Vega, volatility goes up, that's bad. So you're being short a little bit of deltas against short Vega, be a little bit of an offset if we go down. And here's the graph at expiration. So you can see here's the 0 line. So I have no risk on the downside. This is where SPX is, around the 2029 level. This is where the current price is. And this is the graph. So you can see the break even at expiration is, we're all the way up there, almost at the what's this here? 2110 area, or crosses 0. And we got a lot of room here. selling you out of the money. So that's the graph at expiration, right? That's the graph at expiration. This is the graph of the trade today. As you can see, you got to be careful on a quick move up. This is the graph of the trade today, right? So we got to be a little more careful on a quick move up early in the trade. But again, with the market at these levels, if the market goes down, I make money. If it goes down moderately, I make money. If the market's neutral, I make money. If the market goes up a little bit, I make money. It's just one scenario I have to deal with. And so the attractiveness is people like to trade, especially in a volatile market where, hey, I've only got to play fireman. I've got one thing I've got to defend if this thing goes up quite a bit. And so to me, with the levels of 2050 and higher in the SPX, I like doing these type of trades. That looks like a broken wing butterfly, more of a situational trade. But I like these trades, and they can work very well. That's what I like. A couple of questions. Are there any upside adjustments? Well, let me start with the first question. I'll work my way down here. All right, first question says, does the ratio butterfly have any advantages over an unbalanced skip strike butterfly? Does the ratio butterfly have any advantages over an unbalanced skip strike butterfly? A lot of times what I've seen, the margin's cheaper. So he's talking about skip strike. Like if you look here, I'm buying the 2075s, selling the 2085s, and buying the 2095s. So there's 10 points distance between each of the strikes. An unbalanced skip strike butterfly would just be something like this. Buying the 2075s, selling 2 of the 2085s, right, 2085s, and then skipping the 2095s and going to the 3005s, right? That would be a skip strike. It'll have a similar graph. I like this. It seems to me, at least what I've noticed, is a little less margin, but they're very similar. Would it be wrong to call this a, would it be wrong, another question says, would it be wrong to call this a modified bear call spread? It would not, because I'm starting with 3 call credit spreads, but I'm using one vertical to, it'll cut down some of my potential profits on the upside, but it'll give me a little more protection against the upside move than just a call credit spread. Another question says, is there any upside adjustment? Yeah, the upside adjustment would be buying a vertical. Either, so probably as we're going up, I may buy 1 2075s, sell 1 2085 as we go up as a first adjustment, do a small 5 wide vertical, buying 1 of the 2075s, the one I'm already long, and selling 1 more of the 2085s that I'm short. Right now, skip strike is not giving any credit though. Okay, oh, it isn't, okay. Oh, thanks, you know, that's okay. Instead of a butterfly, can't we have a vertical credit spread? You can, right? Who says, instead of a butterfly, can we have a vertical credit spread? Yeah, what am I doing here? I'm taking, instead of, if I do a credit spread at this level, at 2029 in the SPX, what am I saying, right? If I do a vertical credit spread, right? If I do a credit spread right now with SPX at 2029, what am I saying to the world? What am I saying, right? I do a call credit spread out of the money in SPX right now with SPX at 2020, and what am I saying? I'm saying right now, let's go, babe. I am thinking we're going directional. I don't stinking know. I know we're in the upper end of the range probably. Could be wrong. But again, am I willing to get a little help on the upside? If you come to Chicago with your convertible and bald tires, and when you come to Chicago, there's a snowstorm, are you willing to pay up a little bit to get some better tires? Are you willing to pay up a little bit to get some better tires, some snow tires? I'll give you an answer. Yeah. So that's all it is. You can do a call credit spread, but you'll be calling me on the phone when we go up saying, hey, Dan, you think I could still get that vertical at a good price? No, you're going to pay up, right? So it's just again, there's nothing magical here, right? If we were at 2130 in resistance in the SPX, yeah, maybe I just go call credit spread. But again, how many of you are extremely confident at 2030 in the SPX? How many of you are extremely confident that this is the top for the next couple of weeks? How many of you are just extremely confident that 2030 in the SPX is the top for the next 2 weeks? How many of you are? Anybody here extremely confident that 2030 is the top? No, of course not. So that's what I'm saying. Yeah, Bob says I've never been extremely confident about anything. I'm in the same ballpark as Bob. Yeah, I don't stinking know. But I think, at 2050, 26 and up, I'd rather start working from the call side. You know what I mean? We have many students in our community who are, because, let's face it, for a 15 delta in the call, you're not going to get as far out of the money as a 15 delta in the put. So 90% of the strategies a lot of our folk will do, out of the money put stuff, because it gets you a lot further out, right? A lot further out of the money because the volatility skew. But, at 2050 and higher, I don't really care. 2050 and higher in the SPX, it's time, right? It's time. I'd rather go from the call side, right? I don't know if that's the wisest thing in the world to start to be on the put side at 2050 or higher, right? Doesn't mean we can't go up, right? I don't know which way we're going, but, at 2050, after being up, 200 and some points, I'd rather play it from the call side, right? I don't, that's just me. All right. So any questions on that? That's just a ratio call sign, nothing complicated to it. All right. Now, if I am, VIX is 14.15. If I am going to do a short Vega trade, right? Look, if you have any more questions, I talked about how do we manage risk on this trade. I mentioned earlier, somebody asked a question. This will be recorded. Somebody asked a question on what would I do. I mean, there's only risk. As far as risk management, there is no risk management on the downside. On the downside, it's, butter your toast, have your orange juice, and hug your wife, right? That's the downside. There's only adjustment on the upside, and I talked about risk management. For an adjustment, we talked about doing a vertical trade. So this will be recorded. You can go back and, as far as the risk management, how I might adjust it on the way up, right? But again, let me just say, as far as, just say this real quick here. On any trade, right? On any trade, if I'm not going to put any trade on until I can answer these 4 questions, right? This is called a plan. I don't put any trade on unless I have these 4 blanks answered. Number 1, what's my profit target? And a lot of the trades that we do might be 10 to 15% potential, at least a target profit, and that's 10 to 15% of the risk of the trade or the margin. So number one is a profit target. Number two, in any plan, you're not going to like this, maximum loss. How much, at what point do I say, remember Roberto Duran and Sugar Ray Leonard? What did Roberto Duran say to Sugar Ray Leonard? Anybody know? No mas. He knows a sports writer for the Chicago Sun-Times, so I knew he would get that. No mas. He'd get that quick. Many people got it, right? So our maximum loss, at that point, I'm done, right? And that'd be about 15% of the risk, right? Now, these are the most important things in a plan. We say that in Spanish, English, and a little Somalian. The number one and number two most important things on a trade to me are not anything to do with the word that begins with A, adjustment. That's number three. So number three is when to adjust. And number four, how to adjust, which technique. You know, was at work that night of the fight, right? So, in other words, do you have to do any adjustments? Can you keep things simple? No, you don't have to adjust. Right? In every trade, you have a profit target. It doesn't have to be what I'm writing here. It can be whatever you choose. But there has to be some kind of, there has to be some kind of relationship between your profit and your loss. I can't say I'm willing to make 10%, but I'm willing to lose 100%. Well, you're not going to be in stinking business law, right? So they have to be close to each other. But these rule the trade. Adjustment is, you know what adjustment is saying? Adjusting is saying, hey, you know what? The most I can lose, let's say it's a $1,000 trade. The most I'm willing to lose on a $1,000 trade is 150, 15%. Once I'm down 150, unless I have a note from the president and 3 school teachers, I'm done. That's not the time to start adjusting, right? Now, where adjusting comes in is say, if this is the most I'm willing to lose, when I'm down maybe a half or a third of that amount, right? Maybe $50 to $70, hey, I might look to adjust to keep myself in the trade longer, avoid or prolong my max loss before I get hit. But the whole idea of adjustment is just to keep us in the trade longer until we make some money, right? So, but again, I can't adjust when I'm down 150 points, right? You can't play blackjack at Vegas when you've gone through all your money. No. And then how we adjust depends on the market. You might use a vertical trade. You might buy a call or a put. But in other words, this is our plan, right? And again, I don't teach putting on any trades unless you have a plan, right? And the most important thing is you can't be making, $1,000 every month for 3 months, right? And then the 4th month, lose 10 grand, right? So if I had to tell you, if someone asked me, hey, Dan, you've been doing this a long time, right? What do you think is if you could, let's say you could only tell people, let's say you weren't going to, let's say I was going to become a ballet dancer, right? That would be an ugly sight. Let's say I become a ballet dancer, I'm never going to deal with options again. I said, Dan, what are your parting words? Give me, what do you think is the most important thing you've learned in option trading in 30 years, right? And I would say this. in about 6 sentences. And what I'm saying, the good thing is what I'm saying has nothing to do with your understanding of intrinsic value or implied volatility, or whether you understand the difference between an iron butterfly, an iron condor, and a muga maga haga huga, right? The most important thing, if I can impart anything to you, option trading has nothing to, you could know nothing about options and totally understand what I'm going to tell you next. Number one, treat this as a business. If you're doing iron condors or butterflies, again, do them every period of time, every month. I don't care what anybody says. Do them on a regular basis. Consistency. Don't do them because the chart or your neighbor says that, again, you just put them on consistently. And number two, right? Don't lose more on a bad month than you make in a good month. Keep those numbers. So if I'm making 100, I'm making 1,000 in January, 1,000 in February, 1,000 in March. Could I lose 1,600 in April? Even $2,000 if I could. I'm not happy about it, but again, it'll keep me trading. I won't lose my confidence and stop. But if you make $1,000, make $1,000, lose 10 grand, you're going to stop trading. So again, very simple. It's a lot. People make it way too complicated. And the other thing is, let me just say the third thing. Now, you guys, for people who don't know me, this is going to tick you off. Ready? For people who don't know me, this is going to tick you off. Right? Ready? Number 3. All right? Be prepared. You can take your charts and stick them wherever you want. Stick them in the ocean, stick them in your ear, stick them under your bed. But you know what? If you want to learn the craft, I'm not saying, obviously I'm being facetious here. You can look at the ranges and stuff, but spend half as much time. If you spend 50% of your energy, spend half as much time learning the craft, learning the strategies, knowing your vehicle, knowing the range of your vehicle, as you do figuring out where the market's going to go and everything, I'll tell you, all you guys would be great traders. You agree? You agree? Again, control the things that we can control, right? When watching CNBC 8 hours a day or any show where they're telling you which way the market's going, you don't stinking know, right? Come on. All right, let's move on. Let me give you another trade. One more trade. One last thing. One last trade. I don't want to make this too long. I think we're going to start, not next Monday, but the Monday after. We're going to start these, we do Sheridan Mentoring TV Tuesdays and Thursdays. We do them for like 10, 15 minutes. We'll give a strategy. I might put a trade on that I'm doing or something, and we'll just, little bits of teaching. But and I'm going to start not next Monday, but the Monday after we'll start. The Monday webinar series will go every Monday. It'll be a little more detail, about 45 minutes, a little more teaching. It will be a whiteboard teaching. It'll be a little bit of teaching the strategies and giving a little more meat to it than a 15-minute thing. We'll still continue doing Sheridan Mentoring TV on Tuesdays and Thursdays at 1 Central, but on Mondays we'll do this a little more in detail, 45-minute thing, and it'll be, you can put it down in your calendar, a week from Monday we'll be starting them. And I will not be talking about Fibonacci. I might be talking about pasta, though. All right, so here's the last one. Just another little trade. In this environment, all right, as volatile as the market's been, would you rather deal with price risk in one direction or two directions? With the way the market's been moving, would you rather deal with price risk in one direction or one direction, right? And that's what people in the markets get busy if they can just deal with risk in one direction. So here's one that basically has just a little bit of risk in one direction. Let me show it to you. So here's the trade. This trade is going to be I call it a time bomb broken wing butterfly, but that's a mouthful. So we'll call it an out of the money, and we'll call it a out of the money butterfly, but it's kind of a broken wing. So let me spell it out to you. SPX is at 20.32, down 4.5 points for the day. Now, Dino's right. I'm naming trades, and I don't know what to call this. So here's the trade. Buy 10, sell 20, buy 30. I'm in April. I'm in May expiration, so what's May? About 60 days? Somewhere about May. Am I doing the right May? Let me just see here. I wanted to do the regular May expiration. All right, here's the regular May expiration. So what's May? The regular May is what, 60 days? So SPX is 2032. We're 57 days out, thanks, Dino, for May expiration. So I'm in May. This trade is in May. I'm buying 10, selling 20, buying 10. I'm starting with my, I'm selling the 1950 puts. That's how I started. The delta of my short put is approximately 27 or so. 25, 27, we'll call it 26. I'm going a little bit closer to where the price action is. I'm buying 10 of the May 2000 puts. And then down here, I am buying the 10 of the 1880 puts. Right? So a regular, obviously, here's our short strike here. Our short strike is 1950. The current price right now is 2032, right? So this is where the price is right now. And I'm doing something, if this is the zero line, I'm doing something with very, very little risk on the upside. Agree? Agree? It says very little risk. Here's the zero line. You with me? All right. So you can see if this is where the market is right now, if I'm going to do a short Vega trade with the VIX at 14, I'm going to lean a little against my short Vega, lean a little bit short deltas. It's a little cushion for the downside. Short deltas will help me, the short Vega won't. And I'm starting it out of the money. So my short strike is 1950. We're currently at 2032, which is here. Very little risk on the upside. So a typical out-of-the-money butterfly that we would do would be buying the 2000 strike, selling the 1950, and then buying the 1900 strike, right, where the distance between all of my strikes would be 50, right? And the problem with that is it would be cheaper margin-wise than this trade, but I'd have risk on both sides. So by doing a broken wing, right, a balanced butterfly would be balanced out of the money butterfly, thus a 2032, would be buying the 2000, selling the 1950s, and buying the 1900s. But if I want to get the debit pretty closer to zero, I'm doing broken wings. So instead of buying the 1900s, I'm buying the 1880s. And so I'm getting a very small debit. Right now, the debit on this trade is about $1.75. So that means my total risk, if SPX goes up to $1 billion, which it won't, is $175. And this might be like a $20,000. No, this isn't a $20,000 trade, is it? It depends on the brokerage account. But so I'm bringing the debit very small. All right, everybody understand this? And again, both of the trades that I talk about today, the risk management, I could teach you the risk management in less than 30 seconds. Very easy. Very easy, right? There's basically no risk in one direction, and we just do a simple vertical or something in the other direction, and this is no different. So I'm choosing the short strike based on the delta in this example. Maybe get a delta between 26 and 30. All right, so I'm leaning into my pain. What's my pain? My pain in this trade is a lot of short Vega, right, because I'm selling some out-of-the-money puts. So I lean into that by being a little bit short delta and having my out-of-the-money put, or have my short put, way out of the money, right? A couple things I want to show you. If you look at this trade, if I progress, or on March 24th, if I progress almost 3 weeks into the future, what do you notice? This is how the graph of the trade looks about 3 weeks into the future. What do you notice on the upside? That even though at expiration, right, even though at expiration, at the beginning of the trade, it showed my upside below zero, right? Showed my upside below zero. As I go into the trade, as I progress this to April 18th, right? I'm still in the profit zone outside of it. As we go outside the tent, right, which is the profitable area of the trade, this is the graph at expiration. This is your expiration graph. I can make money, right? So I did this for a very small debit. Right now it's trading mid-prices live. It's about $1.60 debit, 160 bucks. So my upside is fine. I only have the downside to deal with, right? Right, I only have the downside to deal with. So if I look at the trade, I'm buying the 2000 put 10, sell 20. I'm buying the 1950 put. I'm buying the 1880. As we go down, one of the things I can do is, you know, as we're going down, I can just do a vertical. I can roll some of my shorts. You know, if I need to buy 2 of these, the 1950 put, right, and roll them down to the 1980. That's called a vertical trade. I can do those to cut my position deltas. But again, both of the strategies I talked about today, one of them, the first one, with the VIX at 14, had no volatility risk on the downside, even though it was short Vega. In this trade, I'm leaning a little bit short deltas into my short Vega trade with the VIX at 14. So anyway, just something to swallow. We'll be back a week from Monday. This will be recorded if you want to watch it. I'll do a few questions and then we'll call it a day and let you guys go and make some pasta. So again, there's only one adjustment if we start going down a lot, and it's just, as I showed you, you just do a vertical and buy in the short. So if I did the vertical, the type of vertical might be buy two of the 1950s, the shorts, and then I might roll them down to the 1940 strike. I'm not going to do a vertical and roll them all the way down here. So I might buy, you know, two 1950 puts, sell to 1940. But, you know, again, if you're new, you could say, hey, I don't want to do any adjustments, right? I'll just try to make, you know, I'm trying to make 8 to 10% on this. And if I'm down over 15, 16%, I get out. So, I mean, you can make this as simple as you want. But even, you know, as complicated as like I just talked about one adjustment, right? All right. Am I selecting the short strike based on a certain delta? Yeah, I'm looking around a 25 to 30 delta for my short put, 25 to 27 delta. The margin, I think, in a portfolio margin account is going to be low. It would depend in a, now this is a $20,000 trade, but I was doing 10 by 20 by 10. So if I only did 1 by 2 by 1, it'd be a $2,000 trade. Yeah, you can do this trade 1 by 2 by 1. Yeah. Why the 26 delta instead of the 25? No reason. Yeah, 25, 26 is good. And these could be for VIX at 14. These are kind of how I would set up a couple trades. Would a diagonal be more effective in terms of the delta vega inversion? It depends on the type of diagonal you're doing. Yeah, same way, it depends, but it could. I don't know about more effective. I mean, every trade has got pluses and minuses. The max loss would be probably 15% here. Any reason not to do this trade in a closer expiration? No, I think in any portfolio of option trades, you want to diversify your durations. You know, so I talk about typically if someone's trading a 30 grand portfolio of option trades, I like to have 70 to 75% of my capital in 30 to 50 day trades, and 25 to 30% in weekly trades 4 to 12 days from expiration. All right, folks, that's my 2 cents for today. We'll be back a week from Monday, and we'll get into some more teaching on different things. I'll just be looking at different trades, more teaching why I'm doing it type thing, and we'll go from there. Folks, you have a great holiday, Easter coming up, and as I said, we'll see you a week from Monday. Thank you.